Hello, folks. Good morning. Welcome to another episode. This is Forex Trading, Falcon Markets Presents, and I'm here today to introduce you guys into Forex trading. And I know many of you, maybe you are just still wondering, how can I start trading Forex? And here is the beginning guide on how you can start trading Forex. First of all, as everything begins, my name is Kimboy Towit, and I'm here to introduce you to this lecture of Forex trading. So, from the beginning point of view and perspectives, I'm pleased to introduce you to Forex trading. So, for the first time, what is Forex? Forex simply means foreign exchange. Forex is just foreign exchange. It is the short term word of foreign exchange. And in Forex, we have something called trading. So when we combine Forex and trading, we get something called Forex trading. And what is Forex trading? Forex trading is just trading or exchanging one currency against one another. For example, a currency pair called Euro USD. You are trading a euro against a US dollar. That is called Forex trading. In Forex trading, we have concepts that it's a must that you learn and you master it before starting trading Forex. In this lecture, I have three main and the basic concepts. That is market structure, supply and demand or smart money concepts at large, and the third one is liquidity. So let's venture into the first one, which is market structure. What is market structure? Market structure refers to the analysis of price action and the identification of trends, ranges, and potential turning points. Analysis of price action and the identification of trends, ranges, and potential turning points. In market structure, we have two waves, or we have two market structural. That is bullish and bearish market structure. In bullish structure, we normally call it motive waves. Motive waves or bullish market structure. And the corrective wave is just the bearish market structure. Why we call it corrective? Because it is correcting and sweeping liquidities that was left by market while it was on a motive wave. That is why we call it corrective wave. So the next point here, guys, is something called supply and demand. That is part of smart money concepts. And in smart money concepts, we have something called supply and demand. So what is supply and demand? Supply and demand is just aggressive buying and selling at certain key levels. I want you to note this, guys. Supply and demand is just aggressive buying and aggressive selling at certain key levels. What is supply? This is when the market is dumping down aggressively, where we are in a bearish market scenario. For example, in this case, this is corrective wave for the bearish trend. So this is supply that caused this massive move downwards. Demand, this is when the market is dumping up aggressively or bullish trend scenario. This motive wave or bullish trend, this is what caused this move is called the demand. The buyers overpowered sellers and dumped market up. That is called bullish market structure. And for that case, guys, we have to know why we are trading the smart money concepts. Why do we trade smart money concepts? This is because you are trading with big players that moves the market, like banks, hedge funds, and all those other that influence market moves. Let's venture into the third concept, which is liquidity. Liquidity. Market. This refers to which the state of market is delivered or sold both without its without affecting its price. Refers to which state by which market is sold or bought without affecting its price. For example, where do we find liquidities? In liquidity concepts, we have a larger interface of liquidity whereby we are going to come and teach that on another lecture. But for now, it was just an introduction. So liquidity is just something that markets must fill large and huge orders. Something that markets must fill for it to facilitate the next pullback. That is called liquidity. So liquidity normally has two types. So liquidity, the first type is called the internal range liquidity, and the second one is external range liquidity. And the internal range liquidity we find on some things called order blocks and fair value caps. And the external liquidity is just liquidity resting above the swing high and below the swing lows. Resting above the swing high and below the swing lows. For example, this is our swing high. This was our swing high before this move. So that means there are some liquidities that market has to sweep before the original move to the downside impulses. This is why this market went upside, closed above this high, that's sweeping liquidities resting above here, and then ditching out the massive move downwards. The same is this point. In this point, there are some liquidities that were resting below this point. This was the extreme low, swing low before this move. So that means market aimed to sweep these liquidities fast for it to facilitate this impulsive move upwards. So, ladies and gentlemen, let's venture into the charts and try to see on how does these liquidities work. And for our case, I want us to use the Euro USD market. So we are now on Euro USD market, and we are here to point out the market structure. So, for example, from this point of view, we can see that the market is moving down aggressively. So we can start mapping out the internal low and the internal high. So from this point, this was the last break of structure upwards. This was the last break of structure upwards. So this is our break of structure. So in this point, we have something called liquidity. So here we have something resting here. Okay. So here we have something resting over there, that is liquidity. So and when you see this market came down, failed to break this low, went up, swept all the liquidity that was resting above this high before the real or the actual move downwards occurred. So guys, I want you to be very keen on how you map your break of structures and the change of characters. So here to This is our fast internal market structure. This is our fast internal graph structure. So in that internal graph structure, thus the market has turned bearish. So the market turned bearish from there. That is our market bearish scenario. So we have to clone this. Just map the market structure. Yes. That is it. We clone this one also. We clone that one. This of structure outside. So we have another tiny structure. So that is our internal structure. Next, another tiny structure. Downside. Yes, another structure. Downside. Structure. Downside. And here is another structure downside. And we have the last of structure downside. The tiny one is the tiny structure downside. So guys, and here we came and broke structure. That is the first internal low. We came, broke structure, and at the same time we changed. So the market changed character and was our change of character. So here this was on a bearish trend, and now we are on a bullish trend. So in a bullish trend, we map higher highs and higher lows. So this is the lowest low, and this is the highest high. So this is the first higher high. So for this case, if this market was supposed to continue downwards, it could create higher lows and lower lows. So, but what happened here? It came down here, it shifted market structure internally, it changed the character and start printing higher highs and higher low. So this is our first higher high, this is our higher low. So there is another break of structure here. So the first break of structure on this bullish scenario, that is it. So the first break of structure, we have another valid break of structure over here. Another break of structure is here. So that is our second break of structure. So we saw here, instead of printing another higher point than this one, it just broke structure, shifted market structure there, and then came down here. Why? Because we know market doesn't move up at a straight line. It must sweep the liquidities first before they check out the actual move. So for example, from this point up, so we saw that it's close, and this is liquidity. We know there is liquidity resting below here. So and the market must sweep that liquidity before it reach out another move higher. So after the market sweeps this liquidity, look at what happened next. The market shifted structure here internally, and it swept liquidity. see, after this liquidity has been swept, look at what happened. So the market came here, retraced a little bit, but failed to break this low. So it broke this high again. So there is another liquidity sweep. So it swept that liquidity that was resting above this point. So after sweeping that liquidity, it also came further and swept this lowest low. So we are still at the internal break of structure, guys. So this is another low. So this low is lower than this low. So this is the lower low. So this market structure happened over there. Swept the liquidity resting below this point and then reached this massive uptrend. Because from here, then the market start shifting bullish. Because as we can see here, our first internal break of structure is here. Our first internal break of structure is there. So that is the last internal break of structure. And it came up here. We got another change of character. So that is a change of character that we got here. Change of character. And we start seeing printing higher lows, higher highs, higher lows continuously. So guys, if you enjoyed this section, please like, share, subscribe. Comment in the comment section what next do you wanna know in Forex trading. See you.